Number 25. So, on January 1st of 2015, Casey Corporation exchanged $3,300,000 cash for 100% of the outstanding voting stock of Kennedy Corporation. Casey plans to maintain Kennedy as a wholly owned subsidiary with separate legal status and accounting information. So basically, we're doing this a little different, okay? Because since they're going to continue to operate separately, we'll have to do some different aspects here. At the acquisition date, Casey prepared the following fair value allocation schedule. It showed the fair value of Kennedy, what we're selling it for, the carrying amount acquired, the excess fair value. So the excess value goes to buildings, and then the license agreement is undervalued. So we've got excess fair value of $274. If we take that away from the $700,000, we've got goodwill of $426. Okay? Immediately after closing the transaction, Casey and Kennedy prepared the following post-acquisition balance from their separate financial records. So here are the assets of Casey, the assets of Kennedy. Prepare a January 15th consolidated balance sheet for Casey and its subsidiary. So basically, they will continue to operate independently. So this isn't one where it's getting dissolved. This is a situation where they're going to continue to operate separately. So the transactions are going to be just a little different as to what we eliminate. Now, we want to eliminate the investment in Kennedy because we're consolidating these financial statements. Okay, so we're not going to show an investment in Kennedy, and we're also not going to show the equity section of Kennedy. Okay, so we're going to eliminate the investment portion, and we need to eliminate the equity section of Kennedy. So how are we going to do this? Let's start by creating an Excel sheet. Now what we're going to do here, we're going to start here by listing the accounts. We're going to have Casey here, Kennedy here. This will be our adjustments. Then we'll have the consolidated statement. Now I'm going to lower this a little bit so we can see it all. Okay? So, let's start by just listing the accounts. Can you guys help me read them? Cash is how much Casey, how much Kennedy? Uh-huh. Okay. And then accounts receivable? Okay. Kennedy? Inventory? Okay. And then Kennedy is $263,500. The investment in Kennedy is going to be $3,300,000, right? And then the building net is $63,150,000, $2,090,000. Oops, sorry. $2,090,000. What's next? licensing agreement. This is 0, but Kennedy has 3,070,000, right? Shoot. Next one, goodwill. Casey, 347. Next one, total assets. Okay. Then we've got accounts payable. Minus 394. This is minus 393. Long-term debt. Minus 3,990,000. Minus 2,950,000. If you see me putting a wrong number, will you tell me? Okay. $2,950,000. I said that? Yeah. Common stock is minus 3 million. Whoops. Minus 3 million. This is minus 1 million. Our additional paid in capital is minus 0. This is minus 500,000. Retained earnings is minus 6 million. This is minus 1,100,000. And then total liabilities and equity is okay? Are we good there? So let's talk about some of the transactions we need to eliminate as a result of this subsidiary continuing separately. Okay? We're going to do this different. Because this subsidiary is going to continue separately, we need to treat it as though it's one entity. So basically what we need to show is, first of all, we need to do an entry. This is the debit side. This is the credit side. Our investment in Kennedy is a debit of $3,300,000, right? We need to eliminate the investment portion. So the first thing we're going to do to eliminate the investment portion is we want to clean up or get rid of the common stock, additional capital, and paid-in capital and retained earnings of Kennedy. We need to clean that up. So we want to remove our investment in Kennedy. And the first method we do is to remove the investment account. We're going to debit the common stock of Kennedy, debit the paid-in capital, debit the retained earnings. So this investment in Kennedy is going to be credited by those three numbers. 2,600,000 we want to eliminate. Now the next thing we want to do is show the fair values that have changed. We see here that it gave us somewhere the fair values. Do you see how it told us the fair values to the building was undervalued $382 and to the licensing agreement was overvalued $108. We need to adjust those, don't we? So let's go back to our Excel. We need to show that this building really is undervalued, that $2,090,000 is undervalued by $382,000, right? And we also know that the licensing agreement that we showed of $3,070,000 was overvalued by $108,000. Is that correct? Does that make sense, guys? Now, we need to figure out what the goodwill is in this company. So basically, how we're going to figure out the goodwill is we're going to take what we purchased this company for, which is how much? $3,300,000? Okay, let's just do this on the side. $3,300,000 is what we purchased it for. Consideration, $3,300,000, right? What were the assets that were transferred in? They were equal to the cash plus the accounts receivable plus the inventory plus the building plus the fair value plus the licensing agreement minus the new value in the licensing agreement, right? Is there anything else? So we end up with doing something wrong. What am I doing wrong? The cash, the accounts receivable, the inventory, the building, the licensing agreement, oh, the accounts payable, minus the accounts payable and the long-term debt, right? Remember, we take the net assets of the fair value? So we need to subtract from this. So minus the licensing agreement and the long-term debt, right? Shoot. What the? Oh, I need to add because I have negative numbers there. There. That looks better, doesn't it? So guys, let me just reiterate what I did there. The consideration is what we're paying for the company. We need to take the fair value of all assets acquired. The fair value will consist of the cash, accounts receivable, the inventory, the building plus the fair value change, the licensing agreement minus the reduction in the fair value, and then we're assuming their accounts payable and long-term debt. That difference is going to be goodwill of $426,000. Isn't that the goodwill? Because it's in addition to what we paid for it. The fair value assets are just $2,874,000. But we paid $3.3 million for it, so it's got to be something. It's going to go to goodwill. So this $426,000 we need to create as an adjusting entry over here